Most Americans don't realize this, but cash could quietly be destroying your retirement. While you're trying to play it safe by holding on to savings, inflation is eating away your purchasing power every single day. In fact, $100,000 today could be worth just $60,000 in 15 years if inflation averages 3%. That's not a risk. That's a guaranteed loss. And here's the worst part. The assets that could protect and grow your wealth are being ignored. But there are 7 proven assets that can beat inflation and are, in many ways, even safer than cash. If you're over 50 and worried about outliving your money, this might be the most important channel you ever subscribe to. Every week, we break down proven strategies to protect and grow your retirement before it's too late. So hit that subscribe button now, because waiting even one more year could cost you thousands. The hidden risk of holding too much cash. Most people over 50 think holding on to cash is the safest move they can make. No market crashes, no sleepless nights, no risks. But here's the hard truth. Cash may be the riskiest asset you own right now. Why? Because every dollar sitting in your bank account is losing value, guaranteed. Let's put this into perspective. If you had $100,000 in cash in 2005 and never touched it, today, that same money has the buying power of only about $66,000. That's a 34% loss in what your money can actually buy. And that's assuming average inflation. With recent inflation spikes hitting over 7%, the loss is even worse. The danger isn't that you'll lose money overnight. The danger is that you won't notice you're losing it until it's too late. Warren Buffett has warned about this for decades. He once said, "The one thing I will tell you is the worst investment you can have is cash." According to Buffett, holding cash during inflation is like standing on a melting ice cube. It feels solid until it disappears beneath you. Here's the trap. Many people entering retirement believe cash gives them control, but what it really gives them is a false sense of security. No return, no protection, and no growth. Now, that doesn't mean you should have zero cash. You need an emergency fund. But if too much of your portfolio is just sitting in cash, waiting for a good time to invest, you're exposing yourself to a slow, guaranteed loss. And most people don't realize it until they're already in trouble. So the real question becomes, if not cash, where should your money go instead? Asset number 1, U.S. Treasury inflation-protected securities tips. If you're worried about inflation, and you should be, TIPS might be the single most overlooked solution for protecting your retirement savings. TIPS stands for Treasury Inflation-Protected Securities. They're issued by the U.S. government and are specifically designed to protect your money from inflation. Unlike regular bonds, TIPS automatically adjust their value based on the Consumer Price Index, CPI. That means if inflation rises, your investment's value goes up with it. You're not just earning interest, you're keeping your purchasing power intact. Warren Buffett has always said that preserving purchasing power is more important than chasing high returns. TIPS do exactly that. They don't promise to make you rich overnight, but they're one of the few assets that guarantee your money won't quietly lose value over time. Here's how it works in practice. Let's say you buy $10,000 in TIPS with a 1.5% interest rate. If inflation rises by 4% that year, your principal adjusts up by that 4% to $10,400. And you earn 1.5% interest on the adjusted amount. That's powerful, especially in retirement, where every dollar must stretch farther. TIPS are backed by the full faith and credit of the U.S. government, making them one of the safest investments available. They can be purchased directly through Treasury Direct or inside retirement accounts like IRAs. The mistake many retirees make? Ignoring TIPS because they sound complicated. But the truth is, they're simple tools that protect your wealth in the one way cash can't, by fighting inflation automatically. If you're serious about not outliving your money, TIPS deserve a place in your retirement strategy. Asset number 2, high-quality dividend stocks. There's a reason Warren Buffett has billions invested in companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble. They're stable, proven, and they pay you to own them. High-quality dividend stocks are one of the smartest ways to generate steady income during retirement, while still keeping your money working for you. Unlike cash, which just sits there losing value to inflation, dividend-paying stocks give you real income, usually every quarter, and often grow that income year after year. Think about this. If you owned $50,000 in a dividend stock paying 4% annually, that's $2,000 a year in passive income. And if the company increases its dividend over time, as many blue-chip companies do, your income keeps rising. That's a built-in hedge against inflation without needing to sell your shares. Buffett calls this owning wonderful companies at fair prices. These are businesses with long histories of success, strong balance sheets, and products people keep buying no matter what the economy does. They generate consistent cash flow and return a portion of that to shareholders like you reliably. A common fear is market volatility. But here's the truth. Many high-dividend companies are far less volatile than the broader stock market. In fact, during downturns, investors often flock to them for safety and income. Examples? Buffett's long-term stake in Coca-Cola isn't just about brand power. It's also about decades of rising dividends. The company has raised its payout for over 60 years. That's exactly the kind of stability retirees need. And here's the kicker. With dividend reinvestment, your income compounds even faster. You get paid, and those payments buy you more shares, which then pay you even more. If you're not using dividend stocks as a cornerstone of your retirement plan, you're missing out on one of the most effective tools to stay ahead of inflation while generating lasting income. Asset number 3, real estate investment trusts, REITs. You don't need to be a landlord to earn money from real estate. In fact, you don't need to own a single building. Real estate investment trusts, or REITs, allow you to earn rental income without ever fixing a leaky faucet or chasing down tenants. REITs are companies that own and operate income-producing properties like apartment buildings, shopping centers, hospitals, and even data centers. When you invest in a REIT, you're essentially buying a slice of that income. And by law, REITs are required to pay out at least 90% of their taxable income to shareholders, usually in the form of steady, predictable dividends. Warren Buffett has long understood the value of owning income-generating real estate, and while he prefers to own businesses outright, REITs offer a simple way for everyday investors to tap into the same consistent cash flow without massive upfront capital. Here's why REITs are often safer than cash. They produce income, they typically keep pace with inflation, and the best ones hold real assets that retain value over time. Plus, many REITs increase their dividend payouts year after year, helping your income rise alongside inflation. Let's say you invest $25,000 in a REIT paying a 5% yield. That's $1,250 a year in passive income. And because REITs trade on the stock market, they're far more liquid than physical properties. You can buy or sell shares easily with no closing costs or property maintenance headaches. Of course, not all REITs are created equal. Stick with those focused on essential services, healthcare facilities, residential housing, infrastructure, and with a solid history of dividend performance. These REITs tend to weather economic storms better than retail or office-heavy funds. For retirees who want consistent income, diversification, and inflation protection, REITs are one of the most practical ways to get exposure to real estate without the real estate problems. Asset number 4, I-bonds, the inflation-fighting bonds. Almost no one talks about. This might be the safest investment most retirees have never heard of. I-bonds, issued directly by the U.S. Treasury, are one of the few assets that guarantee your money will keep pace with inflation no matter what happens to the stock market. So why aren't more people using them? Because I-bonds aren't sold by brokers. They're not pushed by financial advisors. You have to go to treasurydirect.gov to buy them yourself. But once you understand how they work, it becomes clear why Warren Buffett-style investors value safety and preservation of capital. And I-bonds deliver exactly that. Here's what makes I-bonds unique. The interest rate is made up of 2 parts, a fixed rate, which stays the same for the life of the bond, and a variable rate that adjusts twice a year based on inflation. When inflation is high, the bond pays more. When inflation drops, the rate adjusts, but your money never loses value. During recent inflation spikes, I-bonds paid over 9% annualized, far above savings accounts or even many stock returns. And here's the kicker. You don't pay state or local taxes on the interest, and you can even defer federal taxes until you cash them in. Now, there are a few rules. You have to hold them for at least 1 year, and if you cash out before 5 years, you lose the last 3 months of interest. But for many retirees, especially those looking to protect a portion of their savings, that's a small trade-off for a government-backed, inflation-beating investment. Imagine a portion of your retirement nest egg growing tax-deferred, fully protected from inflation, and backed by the U.S. Treasury. That's the power of I-bonds. Safe, simple, and smarter than letting cash rot in the bank. Asset number 5, precious metals. A historic hedge against crisis. Gold doesn't pay dividends. It doesn't grow like a stock. And Warren Buffett has famously said, it just sits there. But even Buffett knows that in times of crisis, gold and silver protect wealth when nothing else can. Precious metals have served as a store of value for thousands of years. When currencies collapse, when inflation skyrockets, or when markets panic, people turn to gold. Not because it creates wealth, but because it preserves it, and that's exactly why it deserves a place in a retirement portfolio. During the 1970s, when inflation soared into double digits, gold rose over 1,300% in less than a decade. More recently, during the 2008 financial crisis, while the stock market fell over 50%, gold prices climbed nearly 25%. That's not luck. That's the role of a hedge asset, and it's something cash simply can't do. Now, Buffett isn't a big fan of holding large amounts of gold long-term because it doesn't produce income, but he does believe in holding assets that protect purchasing power. That's the key. A small allocation to precious metals, 5% to 10%, can serve as a powerful insurance policy against uncertainty, especially when paired with income-generating investments. Gold and silver can be held in physical form, coins or bars, through ETFs like GLD and SLV, or even inside certain IRAs. The important thing is to avoid overpriced collectible coins or aggressive sellers. Stick with trusted sources and keep it simple. For retirees worried about what's next, inflation, currency devaluation, political instability, precious metals offer peace of mind. Not to make you rich, but to make sure you stay that way. Asset number 6, blue chip value stocks, Buffett's favorite for long-term wealth. If there's one strategy Warren Buffett has built his fortune on, it's this: buying great companies at fair prices and holding them forever. That's exactly what blue chip value stocks represent: solid, proven businesses that generate consistent profits, pay dividends, and grow steadily over time. These aren't trendy tech stocks or risky startups. Blue chip value stocks are household names. Think companies like Johnson & Johnson, Coca-Cola, or Procter & Gamble. They've survived recessions, market crashes, wars, and still kept delivering results. Why? Because their products are essential, their operations are efficient, and their business models are built to last. Buffett has said many times that he looks for companies with a durable competitive advantage, what he calls an economic moat. That could be a strong brand, a dominant market position, or a product that people buy repeatedly. When you invest in these kinds of businesses, you're not just hoping for growth, you're buying reliability. And here's why they're safer than cash. While cash loses value over time, blue chip stocks often increase in value and pay dividends, which also tend to grow year after year. That's a double benefit: appreciation and income. For retirees, that's crucial. Let's say you hold $100,000 in a diversified mix of blue chip stocks yielding 3%. That's $3,000 a year in income, which could rise over time as companies raise their payouts. Meanwhile, your shares may grow in value, offering long-term capital appreciation. Buffett's own portfolio is filled with these types of companies, not because they're exciting, but because they work. They deliver value, protect against inflation, and compound wealth over time. If you want long-term security, inflation protection, and steady income, blue chip value stocks should be at the heart of your retirement portfolio. Asset number 7, private credit and fixed income alternatives, stability. Outside the stock market, most retirees think their only choices are stocks, bonds, or letting cash sit in the bank. But there's a powerful category of investments flying under the radar: private credit and fixed income alternatives. These are income-producing assets that operate outside of Wall Street's daily roller coaster, and they're attracting billions from institutional investors and pension funds. Private credit refers to loans made directly to businesses, typically by non-bank lenders. In return, investors receive steady monthly or quarterly income, often with yields between 6% and 10%, far higher than most government bonds or dividend stocks. And since these loans are often secured, the risk can be well managed, especially when working with reputable firms. This is the kind of strategy that fits Buffett's thinking perfectly. He's often said that the best investment is one that earns predictable cash flow from a real need. Lending money to established businesses at fair terms fits that model. You're not speculating on stock prices, you're earning interest, just like a bank. Another alternative gaining traction is interval funds or bond-like funds that invest in real estate debt, infrastructure loans, or equipment leasing. These funds provide access to asset-backed income with relatively low volatility. And while they're less liquid than public stocks, that's often a benefit. It keeps emotions and market panic from disrupting your plan. For retirees, these assets offer something rare: high income with lower exposure to market swings. They're especially valuable in periods of economic uncertainty or when interest rates are rising. While these investments aren't right for 100% of your portfolio, even a 10 to 20% allocation can add significant stability and income, and in retirement, that combination is exactly what most people are missing. If you found this valuable, imagine what you'll miss by not subscribing. Every week you delay could mean more loss to inflation, taxes, or bad decisions. Hit subscribe now and turn your retirement from uncertain to unshakable.